Welcome back to smarthelping.com. I've built an ad network financial model. As you know, in my last video, I said at the end of the year, I'm going to start taking donations, and with that, I'm going to start upping my output of work and just general videos about things I'm doing and building. So, the first step in that is this new model. So let's just talk about real quick an ad network. What is it? Well, an ad network makes money by connecting publishers and advertisers. So you've got publishers on one side that have content and they're trying to make money by selling viewership, basically. So depending on how many impressions they can get with their content, um, they want to make some amount of money, and advertisers are going to pay for those impressions. So, who's in the middle of the publishers and the advertisers to connect them is an ad network. There's probably a million different ways to set this up, but I tried to make it as simple as possible with assumptions that make the most sense based on how I thought revenue should be, um, how it could be generated. And uh, so let's get into it. I'm going to go through each tab, explain all the assumptions, how everything flows, and by then you should have a good idea of what's going on. So we start with the index tab. This just has a list of each tabs, a description of the tab, and then you got some definitions over here. If we go to our first main assumption tab, the control tab, this is where you're going to define the year that your forecast should start, and you'll put that right up in this box C4. You'll put the first day of the first of the year you plan on starting, so 1/1 and then whatever year. Uh, Exit month if necessary. So you could pick any month in the 5-year forecast or choose NA to not have an exit. What this does is it takes the trailing 12-month revenue at the exit month and multiplies it by this multiple, and that's the exit valuation of the business. That would be counted towards cash flows. It would not be in something like an EBITDA line item, but it would show up in your net income before taxes and cash flow. Then we have sources. So, if you're going to start a business, it's going to cost something. You might finance some of it with a traditional bank loan or debt. Uh, After that, there's still cash that might be needed. So here we show that, and it's looking at the monthly cash flows based on all the assumptions, taking the minimum, and that's where this number comes from. So it says to at least have enough cash to stay above zero in each month. You need 1,159,000. So then you say, well, if you need that much, how much is going to come from investors, and how much of the how much percentage of the company are you going to give up to them, and then how much is remaining to come up with for the owners. Now you might have 100% investor proceeds, and you might give away more of the company or more percentage or less depending on what your valuation is. Then just a debt and equity ratio here. So that's just a general like high level. Is pretty standard in every business model or financial model that I do for a given business. So let's get into the interesting part of this, which is the most unique and I feel like the most value of the whole model, is how revenue is generated. So what I've done is I've chosen to do it by publisher type. Um, I thought that was the most relevant thing to drive assumptions with. And so by publisher, I mean, so this could be, you could do three types of publishers. Like this could be all your desktop publishers. This could be all your mobile. This could be like a different, this could be like TV or something else. It doesn't even have to be online. Or this could be three types of desktop publishers or three types of mobile or what have you. I just know that I didn't want to put too many types because it gets a bit overwhelming, but I wanted to have enough so that you could have some granularity in your how you're generating revenue, like the CPM. because it might be higher or lower depending on the type of publishers that are giving the ad impression inventory. So in ad network, so when I say inventory, I just mean, inventory is how much impressions these publishers have that they're trying to sell. And demand for that supply is brought by the advertisers that want to buy, want, if I have a site that sells paintings and I want, to reach 10,000 people per month to see an ad, I'm going to go to this ad network and say, okay, I want to buy 10,000 impressions per month. What's my cost per thousand impressions? And that transaction is where the ad network takes a fee off of that, whatever is being paid to the publishers. So how we're defining this is you've got a start month for each of these, which could be different or it could be the same month. You've got a starting count, which could be, it can't be 0, but it should be some number above 0, and then that count will just grow. So we're assuming when a publisher joins, they're there for the rest of the forecast, and then the amount that your publisher count grows by can change by year, and it's a monthly compounded growth rate defined here. So let's say you put 100 here, we can go over to our monthly P&L. You can see we have it growing at 10% per month in year 1. So you start at 100, then grow at 10% per month. So now in month 2, you're at 110, 121, and so on. This is 10% per month for the first year. And that could change each year, which it likely will. And then you've got your running count or you've got your actual net added per month right below that, which is going to be an important metric to see when you're using this for forecast as well as to measure performance against when you have actual data. All right, let's get back in here. So starting count, how those publishers grow, how fast. Then you have to define the impressions. So this is the monthly impression per publisher for this group. So we're saying each one has 250,000 per month. However, I was thinking about how, if a publisher comes on, it's not likely that they will have the same amount of impressions per month forever. In general, it's likely that that's going to go up. So at what rate does that grow at for a given publisher? So here we're saying you can actually define in year 1 through 5 how fast or what the publisher impression count is growing at each month. And this is kind of isolated. This does not directly reference the year of the forecast. This is referencing, when it references these years up here, it's actually referencing the year of the age of the publisher. So if they joined in year 3 and we have 1% for year 1, that means in year 1, even though it's year 3 for the publisher, it's their first 12 months, they're going to grow at 1% per month for that first 12 months of whenever they joined. And all this is being done. We've got the matrix, which I've done a lot of work with the matrix stuff with SaaS models, but it actually is completely irrelevant for this too, because we have to count, how many are joining in each month. Each month is considered a cohort. So like here in month 1, we have 100 count that joined. We're saying those are already existing or added for the first month. Actually, let's go to month 2. So month 2, we're saying we added 10. Okay, so that's month 2's cohort. We count the age of them in months. So, month cohort 2 joined here. So month 1 for them is actually month 2 on the model. And then it counts forward from month 1 to into the end of the forecast. Then we've got the year, because this is going to be how we reference the age of a publisher. And then we just reference this year by a validation tab. We've got what months correlate to years. That's actually how this is populating. And then once we have that, we can actually get the impressions for each cohort and then add them up all together to get the total impressions for the month. So this is saying we had 10 join. They had 250 1,000 impressions per. So you times that by 10, you've actually got 2.5 million impressions on the network. And you've had 25 million from the other uh, month one cohort for month two. And if you add them together, this is the total impressions for the month. This is your impression inventory. And this goes on as each month as you add new publishers based on how your assumption growth rate for those and the impression growth rate. You can see how that grows. So for this one, we're growing at 1% per month in year one, and so on. And you could change that for each year. So I thought that was interesting because it really is a relevant assumption to make because it's not likely that the impressions, I mean, they could be. If they are the same, you can put 0% here, but likely they're going to go up over time. It depends on where the publisher is at, what their own forecasts are. But I thought that was a relevant enough assumption to include here. Then we have CPM, which is very straightforward. It's just the amount of impressions divided by 1,000 times this, and that's ad revenue. However, I was trying to think about the best way to model matching suppliers and buyers because just because a website or some media has, let's say, 100,000 impressions per month, it doesn't guarantee the ad network is not guaranteeing that 100% of those impressions are going to be sold to advertisers. It depends on what the advertiser demand is. So if I, as a publisher, get 5 million views, let's say to smarthelping.com, well, I may get 5 million views, but the amount of ads that are being pushed to my viewers, there's only enough ad demand to fill maybe, let's say, 80% of that. Now, if demand is outweighing supply, then this is going to be, and you can define this percentage here of how much of the available impressions are being filled by advertisers. You could put 100% here if impressions are essentially equaling, they're all being filled. Now you can work up to 100%. It could change over time. Whatever makes sense for whatever types of content creators and publishers and advertisers you have. This is a way to distinguish that, well, you might not be able to fill 100% of the available supply of impressions. So we have the CPM. It's going to be based on the total impressions of the publisher times the rate filled. Well, the impressions divided by 1,000 times the rate filled times the ad revenue share that the network is taking. So this is actually how the ad network makes money. Based on the CPM, the total ad revenue happening, and this rate is how much, and if we go over to the monthly, it's easier to see. So let's just go to the top down here. So we've got a certain kind of publishers. Those are going to result in some amount of impressions. Some of those impressions are going to be filled. It could be 100%. It could be less than 100%. So we got the fill rate here. That's just the auto formula. Then we have ad revenue, which is just dividing the impressions by 1,000 times the CPM. Then we have fee revenue, which is taking that ad revenue times the percentage defined here, which I just put at 40%. These numbers are all arbitrary. You should be in doing your own research when you fill out the model for your own scenario. My job here is to make sure that the logic works when you put in numbers. Okay, so that's how we get to fee revenue, and it works the exact same way for every tier. So tier 1, 2, and 3, it's just different numbers and different start dates potentially, but they all work in the same way that I just described for tier 1. And on the monthly detail, you can see tier 1, 2, and 3 are all displayed there over the course of 5 years. Consolidated, I just added everything up from all the tiers to get a consolidated view of total impressions, filled impressions, ad revenue, and the fee rate by the ad network. So this is top line revenue of the ad network. And let's say you might be marking up as a ad network, you might be marking up from the CPM. If you are, then you would just include that markup in the CPM rate here. So let's say you're, you know, if somebody's bidding $2 for 1 million impressions, you might mark that up and actually charge them $2.20. The and then you take some percentage of that for revenue, and then the publisher would get the remaining amount. So I mean, who know? There's so many different ways to set this up. So I just tried to get these assumptions as high level as I could, but still make sense to kind of tweak and show performance change over time. Uh, but I imagine, there's going to be customization needs that will be made here for every specific situation. But I still think this is really good for a high level model of ad network revenue. All right, so now that we've got revenue assumptions done, we go to cost assumptions. And the first part of cost assumptions is just general operating expenses. So I've separated it into three categories: sales and marketing, denoted by S and M; general and administrative, denoted as G&A; and research and development, and that's R&D. So you can change all these cells in light yellow with blue text to whatever makes sense. You could enter the start month, which is going to be based defined after when you put your control here. Those drop downs the drop down selection will update. So you pick the start month, the monthly fully loaded costs of whatever the expense is. The reason why I say fully loaded is because if it's personnel, generally they have, you know, benefits, and there's some benefit tax stuff going on there. But if you put the fully loaded amount, it'll just all be captured in that one row for personnel. And then for other things like rent, etc., you can just put in the monthly amount, and that can change over the course of 5 years. So it works the same for all of these: S&M, G&A, R&D. Now we get a little bit tricky here. So I wanted to account for the ability to show if people are paying with credit cards, and you're going to be charged a credit card fee. So you can define that here, and you can define any other general costs that can reference total revenue to come to. So this might not be relevant to you, and you could put 0% for all these, or only one, or some of them could be relevant. You could fill it out as necessary or clear it all out and put zeros. Then we have cost of goods sold. So I try to put any possible way that you might want to drive cost of goods sold. And some of these, or all of these, or only one of these might be relevant. The first one is by tier. You can define just a cost of goods sold of based on the revenue of that tier. So let's say you had $100 of ad revenue in tier one, and your cost of goods sold is 15%, then that would just result in an 85% margin. And if you put it for each one, that means your total margin, and zero everything out, your total margin would be 85%. You can see that's what I did here just to demonstrate. So you can see gross profit is 85% of revenue here, because we just defined the cost of goods sold as 15% of revenues. However, you might not want to do it that way. You might want to zero this out and actually put in here what you think your costs of goods sold are by month per tier. So you can do that here as well if it doesn't make sense to do it just based on a percentage of revenue. So this is kind of a bottom up, this is kind of a top down. Either one can be used here. You've also got maybe cost of goods sold per tier per publisher. So if there's some cost, if your costs are going to be set up so that you can easily define in general for publisher tier 1, 2, and 3 what their monthly cost is on average for the ad network, and it's be hosting, things like that for them to use your servers and your systems. You can put that there as a hard-coded number that could change over time, and it is a variant per publisher type. And then finally, if it makes sense, you could define an amount per impression. So if you know that your costs to host are, based on the amount of impressions rather than publisher type, then you could fill out that, and maybe it's 2 cents per impression, and that's your hosting cost for publisher tier one. And you can change for each type. So there's plenty of ways to define your cost of goods sold, um, and it'll likely be tied to your revenue and kind of participant growth of the network and who's on it. So those are operating costs, cost of goods sold. We also have one-time startup costs, which are just going to be defined here, and these flow to the cash flow for year zero cash flows. Then we have capex, which depreciation is not tied to this, but it just shows for cash flow some future monthly cash outlay that's for something that you can define here, and you can find the month that it happens in. And this is only going to be relevant for the cash flow. I have not done any logic for taxes. If you want to try and show the fact that, okay, taxes are going to be in here, even though we get down after OPEX, we get to EBITDA, you could either just make your own row for taxes, figure out your taxable income. I have separated out for debt service if you do have that interest and principal. Um, but you can either separate it out and apply some rate to positive net income years, or you could go to after you figure out your expected taxable income, you could go over to the cost assumptions and just put some number here for one of these general administrative items and just call it taxes and just show that there's going to be cash going out for that. But there's multiple ways to handle it. I just don't like to get into taxes that much with these models. I like to get, the operating income down, all other cash flow items besides taxes, so debt service, capex, exit of the business, debt proceeds, startup costs, all of that I like to get down to, but usually I don't get into taxes. Sometimes I do. It really depends on the type of model, and this one is not going to include anything with taxes. All right. Well, now I'm kind of where was I? Oh yeah. So costs. So startup, capex. You see those shown here dynamically, the capex and one-time costs. Let's get to, so that's all your assumptions. So after you fill all of that out, all of the model will populate. The only other thing I did was if you want to try to get an idea of the advertisers on your network, you can define an amount here of average impressions purchased by per advertiser per month. So if the number is 150,000, then that means based on the impressions on the network, month one you'd have 125 advertisers. Or if this is like 5 million, then it's less. Whatever this number is, it's just to show the other side of the market because we know publisher counts, but advertiser counts are just going to be a function of the available impressions. And this is, let me make sure, did I do filled? Yeah, this is based on filled impressions, not total impressions um, available. Let's see. Other than that, yeah, those are all the assumptions you would be putting in to the model. Then I just have some high-level summary. So we've got executive summary here, which is just showing you, we've got publisher count, total revenue, cost of goods sold, gross profit, the main expense items, G&A, S&M, R&D, total expenses, EBITDA, debt service coverage ratio. It probably isn't relevant to most cases, but I just have it in here. Percentage of EBITDA margin, um, other cash flow items, capex, debt service, startup costs, proceeds from the exit, loan proceeds, loan payback. And see, this is zero because we haven't put an exit in. If we did put an exit in here in the last month, then you now have loan payback. You also now have an exit value of the business, equity, and mainly the exit value is there for more of a valuation aspect to try and figure out the cash flows in the next 5 years, instead of just, the business might run into for 100 years, but to figure out the value of that over time, especially in relation to when you're trying to calculate internal rate of return and net present value, you need to have some value of the business at the end of the forecast, um, to account for that. So that's what that's for. But again, you can put NA if you don't want to include it. So we got loan payback, equity, cash flow after equity, and then cash position. And then this is just a check to make sure it matches the monthly and annual, which it does. Revenue and EBITDA charts here. Then we've got distribution. So this is kind of, um, I say this is more unique to my models, but it's super important, and that's obviously how you're distributing the cash flows if you have investors and owners that each have a stake in the business. So what I've done here is I've got, first row, these are all monthly positive cash flows. And let me put this back to NA just so the numbers don't look crazy. Uh, okay. So you've got all positive cash flows in each of the 5 years, all negative cash flow months in each of the 5 years. And then we know, based on how much equity was put in by owners and investors against how much debt was taken out, there's some amount of equity that can be used, for these negative cash flow months until you start, um, using profits for that. So before distributions happen. This is pretty clean the way it goes because it's basically you're going to go negative, for the first few amount of months, depending on how your assumptions work. And then once you go positive, the model will probably keep going positive, and you're not going to like have negative operations, then positive, and then negative. You might, I mean, if you have a lot of OPEX happening before, like in, let's say, year three, but year two, you were leaner. I guess you could have negative, cash flows, and that would be accounted for in this logic as well to get to the proper available funds to distribute. So once that's calculated, it's just a matter of, defining the percentage that goes to investors, the percentage that goes to the owners, and then we can do a net present value. Well, basically, this is a discounted cash flow analysis based on the discount rate. Discount the cash flows going to, here we've done the project. Also, we've split out investor and owner. So you've got the total cash flow of the project, the net present value of those cash flows for each party, and as a project as a whole. And then, based on the discount rate, the net present or the present value of those future cash flows, and then based on the initial equity contributed, you can figure out net present value. And for this rate here, there's no right answer. It's just whatever your discount rate's going to be is how risky the business cash flows are. So a higher rate means you think they're more risky and therefore valued less. So the higher your discount rate, the less the cash flow is going to be valued. And the lower the discount rate is, the closer to what the actual cash flow is going to be. So like if I put a 1% rate here, you can see the NPV is going to go up from 43 million now to 65 million. So that's how that works. Then we just have a distribution here to show investor, cash flow, versus owner cash flow, including the initial investments and returns of each. And then you've got internal rate of return for the project here, as well as for the investor and owner. Next, I have visuals. So I thought some of these were pretty cool. The first is pretty standard. I just put revenues for each year against the costs for each year, and I broke costs into cost of goods sold, G&A, SM, and R&D. So if the big blue revenue bar is bigger than all these, that means there's, a positive operating profit. Then I put, just separated out the cost by year, because that could be insightful. Then you've got year-end publisher count, month-end publisher count. You've got monthly revenue by publisher type. And so this is a stacked column chart, meaning if you add all the columns together, that's actually the total revenue for the month. This is monthly. Also filled impressions by tier. So this is how many impressions your ad network is filling per month. in total, and it's broken down into each tier. Total impressions on the network, and then I just took that. This total is the same as this. It's just a line of the total instead of breaking it into each part and it being a um, stack chart. Then we have average CPM. So this is taking all of the filled impressions against the um, actual revenue and getting an average between all three of your tiers. Now, note you could, if you didn't want to do any different tiers, you could essentially do this model based on averages for just one type of publisher. You just put in your starting count. This would be like a weighted average of all publishers, what you think they're going to grow at, and their weighted average of all their CPMs, and then fill rate and revenue, uh, fee revenue, or fee percentage would define revenue. And you could do it that way if you don't want to try and break anything down. But I know some people will definitely want to break it down to see, like, okay, here's all the desktop ads, here's mobile ads, here's TV ads, or something like that. Um, so I think it's important to have three. If I get a lot of feedback from purchasers of this template that want more, then I can make some more. I could put 4 or 5 there. It's not that hard to add them, or 6 or however many that people think is necessary in general. So that's CPM. Then we have estimated advertiser count. So this is again taking the expected amount of impressions advertisers are buying, and then just divide that by the total impressions to get a count there. Then I've compared, so you've got publishers versus advertisers, and that ratio you can see here. It could be relevant to some situations, but I just thought, we've got the data here, so you might as well just show it. Um, and obviously here we're saying there's a lot more publishers than advertisers, and publishers are higher. And that's just a function of this number here, basically, the impressions purchased per advertiser per month. If this goes higher, then the ratio goes, well, there's going to be less advertisers per publisher. If this goes down, then you're going to see more advertisers relative to publishers. And this is just a visual to show that difference between the two. Cash flow, I just did cash flow per year and per month as well. This kind of is a nice way to show when the company starts making profits and then the expected profits in the future. And then that's it. And then basically all those visuals and everything in executive summary are being driven by the monthly P&L detail, which is driven from all the assumptions. So this flows from all the assumptions, rolls up into the annual, which is the same thing as the monthly, but it's just on an annual basis. And then all that flows into the executive summary distributions and visuals. This is our debt amortization schedule for the debt portion if applicable, and then all the matrix tabs to get the impression count correctly done. And that's about it. So I think I'm going to charge $45 for this template because I feel like ad network is a pretty broad industry and there should be a fair amount of demand for this type of model. And so that means my pricing can be a bit lower. Note on my pricing, if I put something at 40, like I have mid-level, intermediate, and upper tier. I just did the ultra tier last month, but that doesn't really have anything to do with the quality of the template or the complexity. It just has to do with what I think demand will be and what I think the best price is in conjunction with that. Like this model, like I could say this model I could sell for, $900. And if you're actually going to do an ad, if you've raised millions of dollars, you're going to do this, then, $1,000 to purchase this would be nothing. But if you're just getting ideas to go, like you're thinking about doing it, you don't know anything really, or you're a student, or you're just you want to kind of dabble in the logic, you haven't raised money, then the $45 price is more common, and there's more people doing that than actually raising millions of dollars to do an ad network. Um, so I built this for both. It would work for both, and because of that, I've been able to price it at 45. So I'll list it at smarthelping.com, obviously, and Eloquent and eFinancial Models. Just seeing here. So um, what I wanted to talk a little bit about is on smarthelping.com. What I've done is a donation tab, and the purpose for that is people can support my ongoing work, like continuing to build and think about different models to do. And when you do donate, you can list suggestions for customizations on previous work, and I could do that and publish it. And if you've already purchased a template, you would just get that um, template you've already bought for free with the update. If I went ahead and decided to do it, also, it's good for suggesting new templates that you want. Um, and so I'm hoping that that gets me working more on templates and focus more on that than doing, searching for hourly work to do. Because I'd rather do this and interact with the community and build things. That's like my dream. So I'm trying to make that more my work, more of that and less of billing work, because this is more fun. But we'll see how that goes. But this is my first step toward just getting more active, posting more videos, and trying to be, even more helpful. All right, I'll see you on the next one, guys.